Good evening, friends. The Palakkad Education Trust is a charitable trust supported with the main objective of promoting education, especially among the financially weak sections, by giving scholarships or educational aid to the children. As a beginning, we want to conduct a series of educational lectures on various subjects which are useful to the trade and business. There has been some changes in the recent budget, Finance Act 2023, which apply for the financial year 2023-24. We are on the last few days of financial year 22-23. From 1st April 23, the new provisions will come into effect. So to make you aware of the changes which you have to keep in mind while transacting business for the financial year 2023-24, we are highlighting certain changes made in the budget. The first change is that we have a new scheme of assessment, section 115 BAC, by which you can opt to pay taxes at a concessional rate if you forego various deductions and exemptions. The government wants to phase out the exemptions and deductions because, as you know, the scrutiny assessment is now limited to a very small percentage of the returns filed. Under section 80C, a deduction of 1,50,000 rupees is allowed for payment of premium to insurance policies and so on. Similarly, under section 80D, in case of treatment of certain specified diseases, up to 50,000 rupees is allowed. In 80D, medical insurance premium up to 50,000 rupees in the case of senior citizens. What is actually happening is that there are many cases where assessees are claiming these deductions without actual payment being made under the respective provisions. In order to avoid such malpractices, the government has come out with the new scheme, 115 BAC, which came into operation from the assessment year 2022-23, 21-22. There has been some drastic changes in the scheme for the financial year 2023-24 relevant to the assessment year 24-25. One basic change is that if you opt for the new scheme, the basic exemption limit is 3 lakhs as against 2,50,000 for other cases. Similarly, for income up to 7 lakhs, the tax liability will be 25,000 rupees, and that 25,000 rupees will be allowed as a rebate under section 87A. In the present scheme, which is applicable to the assessment year 2022-23, you are not eligible to claim standard deduction on the salary and standard deduction in the case of family pension. But under the new scheme applicable for 24-25, you will be allowed to claim standard deduction both in the case of salary as well as in the case of family pension. That's one change. Then one more change which has been introduced in the Amendment Act is that a marginal relief is being now given. Suppose the income of a person exceeds 7 lakhs, it is 7,05,000 rupees. Then that person will be liable to pay a tax of rupees 25,500, whereas his income is only above 7 lakhs, it's only 5,000 rupees. So in order to provide relief to such extreme cases, you lose the exemption because your income increased by a very small amount. Now a marginal relief has been given up to persons earning income up to rupees 27,800 will be eligible for this marginal relief. That is, you calculate your tax liability if the income exceeds more than 7 lakhs. From that tax, you reduce the income in excess of 7 lakhs. That will be allowed as a deduction, and only the balance amount you will have to pay as tax. So this is a new scheme, marginal relief, which was there earlier under the surcharge and all. It is now made applicable for payment of income tax under section 115 BAC. That's a very welcome measure. Another important change is that in the case of assessees having income in excess of 5 crores, they are liable to pay surcharge at the rate of 37% of the income tax. That is, it will almost come to around 10%. Now that maximum surcharge has been reduced to 25%. So this again is a welcome change that will give relief to the people in the higher income bracket. Another important change is that for assessment year 2023-24, you have to make an option to go under the new scheme. Otherwise, the old scheme is the default scheme. But for assessment year 24-25 onwards, the new scheme will be the default scheme. And if you want to continue in the old scheme, then you'll have to make a specific option. So these are the changes with regard to this new scheme of assessment 115 BAC. Another change is that a new section 115 BAE has been introduced. In the case of manufacturing cooperative societies, that is, cooperative societies engaged in the manufacture of goods which are set up after 1st April 2023 and which commence production before 31st March 2024. So the scheme is, as it is available only for 1 year. In the case of such cooperative societies, they will be eligible for a concession rate of 15% tax, 15% plus surcharge if applicable. So that is the new scheme for cooperative manufacturing cooperative societies. Then another change is that in the case of income from online gaming, the income will be taxed at the maximum marginal rate of 30%. There will not be any exemption or differential rate, flat 30%. In the case of manufacturing cooperative societies who opt for the new scheme, there will be no ultimate minimum tax. Another very important change is that under section 80C, we are claiming direction on payment of insurance premium up to rupees 1,50,000. If the premium paying period is 10 years or more, the amount received on maturity of the policy is exempt under section 1010D. That means if you have paid insurance premium for a policy for 10 years, after the 10-year period, on maturity of the policy, you get the assured amount plus bonus, that is fully exempt. Since a lot of people are taking insurance policies for huge amounts, a cap on the insurance premium paid has now been brought in. If the insurance premium for a policy exceeds rupees 5 lakhs in a year, then on maturity of the policy, if you receive the amount, you will not get exemption under section 1010D. But if the policyholder dies and the insurance company pays the amount, it will be exempt. So there is a cap on the high value insurance premiums. It has to be kept in mind. Then another important change is that there are SC is the specified export zones, which are treated as a place outside the country. The income of the SCEZ company as well as units within the SCEZ are eligible for complete exemption from income tax. Now, two changes have been brought in. One is they have to file the return within the time allowed under section 139(1). And secondly, they are deemed exports. So the export proceeds or the sales realization has to be received within 6 months from the end of the previous year. So two conditions: you file the return within the due date under 139(1), and the export proceeds also has to be received within 6 months from the end of the previous year. Then under section 10(22)(b), certain news agencies like Press of India and all, but Reuters, they were given exemption for their income. That exemption has been withdrawn. Then there are certain government bodies for the development of cities like Greater Cochin Development Authority, Bangalore Development Authority, like that. They are tasked with the development of cities, improvement of infrastructure, planning of cities, and so on. Normally, they are all formed by the government under a legislative act. If established by the government in the form of a company or some other legal entity, they will also be granted exemption under section 1046A. That is, earlier it was limited only to government bodies. Now it can be allowed to other entities also if they are engaged in the activities. Then another very important change is, we are all familiar with the agriweeds. The government has changed the method of recruitment to the army. For certain positions in the army, youngsters are selected for a very limited period. I think it is about 5 years or something like that. After that, a portion of a certain percentage of the agriweeds will be discharged from the army, though they are given preference in employment in various private and public sector undertakings. The contributions made by the government and by the Agniveer to a corpus fund, Agniveer corpus fund, is allowed as a deduction. That is, just like your provident fund, the employee has to make a contribution, employer also makes a contribution. So in this case, the contribution made by the government to the fund will be treated as the income of the employee, but it will be given exemption under section 80 CCH. 80 CCH. A new provision has been made. Similarly, any amount received from the Agniveer corpus fund by the individual employee will also be exempt. Then very important change is leave encashment. In the case of leave encashment, in the case of government employees, the entire amount received is exempt from tax. Whereas in the case of other employees, there is a ceiling of 3 lakhs. This amount was fixed very long time back, and there has been a demand for increasing this amount. Now, the exemption with regard to leave encashment has been increased to rupees 25 lakhs. The finance minister made a statement in the parliament, but no changes have come so far. Probably the government may come out with a notification or a circular. Then, with regard to business and the profession, income from business or profession, there are a large number of micro and small enterprises doing business. Because of their weak financial position, their bargaining power is very limited. When they make supplies to their customers, the amount is not paid in time. The MSME Act contains provisions that the maximum time which can be taken for settlement of their bills is 45 days if there's an agreement. If there is no agreement, then the payment has to be made within 15 days from the receipt of the supply. But these rules are not actually implemented. There is a provision. If there is a delayed payment of this amount to the MSME unit, you have to pay interest, which is mandatory, and that interest paid is not allowed as a deduction. All these provisions are there, but in actual implementation, there have been difficulties. So they have amended section 43B. They have amended 43B. See, in the case of payments to MSME units, if the amount is not paid within the due date, it will be disallowed. It will be disallowed in that year and will be allowed as an expenditure at the time of actual payment. See, if you analyze the impact of this amendment, we'll find that this amendment will actually affect only at the end of the year, and that too if you don't make the payment before the due date for filing the return. So any amount paid to a MSME unit, though belated, if it is paid before the due date for filing the return of income, it will be allowed as a deduction. Otherwise, the amount due to a MSME unit not paid before the due date for filing the return will be disallowed as an expenditure, and on that amount you have to pay taxes. Then another important change is, see, if you don't pay interest to commercial banks or government financial institutions, the amount of interest paid is disallowed under section 43B. Similarly, see, there are large or big non-banking finance companies. They are playing a very important role in the industrial development, like your Sundaram Finance, Mahindra Finance, Ashok Leyland Finance, and so on, Tata Finance, and so on. They are providing finance to large industries for purchase of machinery, vehicles, and so on. In their case also, interest is, the servicing of the loan is not proper, and they have arrears of interest. So if an assessee takes a loan from an NBFC, and if the interest is not paid within the due date, then it will also be disallowed under section 43B. So far, as auditors, we were not looking into this aspect. From assessment year 24-25, if the NBFC, if the interest payment to the NBFC is not in time, it will be disallowed. 43B. So that also has to be considered. Then another very important provision is that section 194R. See, in the case of people engaged in business, they get many benefits related to the business. For example, sales charges are fixed. If you achieve a sales target of, say, 2 crores, you will be given a free trip to Japan, or you will be given 5 sovereigns of gold. Like that, so many offers are given, or you will be given a car. Now, till now, there was no method of tracing these payments. In many cases, the recipients were not showing this as an income at all, especially when you receive it in the form of goods. Nobody was accounting these transactions. The government has identified this loophole, and they have now come out with a provision for deduction of tax at source. The person making the payment, that is the company which offers this incentive, before they disperse the incentive in the form of materials or goods, they will have to ensure that tax is deducted at source on the amount, and then only they should release the payment. Suppose you are getting a car. In that case, the company will have to see that the recipient pays that TDS on the value of the car and provides evidence to the person making the gift. Then only the gift should be released. So the recipient will have to pay advance tax on that amount, give the challan, and then he will have to, the person will release the goods or gift. So that's a very important provision made to cover a contingency where the gift is not in the form of cash, but in the form of goods, or partly goods and partly cash. it is the duty of the person giving the gift or incentive to ensure that TDS has been remitted on the transaction. Another very important change is that Section 44 AD and ADA, presumptive tax. Now, a person carrying on business, if the total amount paid or received in cash is less than 5%, that means 95% of the transactions are through bank, then he can opt to pay tax at the concessional rate of 8%, presumptive tax. And in the case of profession, it is 15 lakhs. Now the limit has been increased to 3 crores. In the case of business, if a person has carrying on business with a turnover of up to 3 crores, if the total amount received or paid in cash is less than 5%, that means 95% of the transactions are through bank, then he can opt for the presumptive tax. In the case of profession, the amount is increased to 75 lakhs. That is, if the transactions are through bank, instead of 8%, you can estimate at the rate of 6%. With regard to capital gains, there are some changes. One is Section 54 and 54F. Section 54 provides that when you sell a residential house and that money is invested in another residential house within a period of, in the case of purchase, 3 years, in the case of construction, 2 years. And Section 54F, when you sell any other capital asset and earn a capital gains, and you are investing that capital gains in a new residential house, you are eligible for exemption. What happens is that in the case of metropolitan cities like Bombay, Delhi and all, the capital gains amount itself will be in terms of 25 crores, 50 crores and so on. And assessees are getting exemption by investing that amount in a new residential house. That means there is a huge tax leakage. Though it is legal, there's a tax leakage. So now the government has set a cap. In the case of this 54 and 54F, the maximum deduction you can claim is now limited to 10 crores. So if the capital gains is more than 10 crores and you invest in a new residential house, up to 10 crores you can claim under 54 or 54F, and the balance amount you'll have to pay tax. Similarly, there are certain other small changes, especially with regard to this market-linked debentures. Earlier, it was treated as a long-term capital gains eligible for indexation. Now it will be treated as a short-term capital gains. Similarly, in the case of goodwill, self-generated goodwill or assets of a similar nature for which there is no cost, then you will have to pay tax on the entire amount capital gains without any deduction. Then conversion of gold into electronic gold receipts. See, because there is a lot of digitalization, the government also wants to utilize the gold for productive purposes. So it is possible for us to deposit the gold and convert it into a electronic gold, and it can be reconverted also. So in such cases, when gold is converted to the electronic gold receipt or vice versa, there will be no capital gains. Similarly, the government wants to develop India into an international financial center. An international financial services center is being set up at Gift City, Gujarat. So a lot of concessions are being given to the income earned by entities in this international financial services center. So when you transfer your business from outside India, outside the place to the international financial center, you will be eligible for exemption from capital gains and so on. Then another important change is with regard to Section 194 IC, that is when you sell property. Under joint development agreement, the landlord gets completed flats as his share. for parting with the land. Now, this flats are valued at the stamp value rate. For purposes of taxation, the landlord will value the number of flats he received at the stamp value valuation, and on that amount he will pay capital gains. Now, and subsequently he may sell the flat at a higher rate. So whenever, or the builder will give him cash remuneration also. For the purpose of section 194 IC, the stamp value of the flats plus cash consideration, if any, that also has to be considered for TDS. Then there are some very important changes regard to the registration of charitable trusts. Earlier, a charitable trust which is granted registration, let us say for the assessment year 2023-24, and the assessment of that charitable trust for the earlier years 2020-21 or 21-22 is pending before the assessing authority. There is a provision that when a charitable trust has been granted registration in the later year and proceedings for the earlier year are pending before the assessing authority, and taking into fact that there are no changes in the activities or the nature of the charitable trust, the trust should be given exemption for the earlier years also, though it got registration at a later year. Now that scheme has been done away with. Now the provision is that as soon as a charitable trust is created, 1 month before it starts its activities, the trust will have to apply for a provisional registration, and as soon as it commences its activities, it has to apply for a permanent registration. So the registration, see, that means if you get a registration in a later date, you will not get exemption for the earlier years. So before you commence your operations, the charitable trust will have to apply for a provisional registration, and immediately on starting its commercial activities, it has to go for a permanent registration. That is one important thing. Another important change is that this utilization of the amount received. There are cases where the current year's revenue received, that is the amount received towards current year's activities, is less, but the trust takes loans from the trustees or from other sources and makes expenditure, or the trust is having capital fund, investments are there, the trust is either taking a loan from the investments or disposing of the capital fund and then spending money for the current year's activities. That the total amount spent was treated as amount spent for charitable activities. Now that scheme has been done away with. So when a charitable trust either liquidates its investments corpus fund or takes loans and incurs expenditure for its activities, that portion of the expenditure will not be treated as current year's expenditure. For calculating your 85% spending and all, that will not be considered. And when the loan is repaid or when the investment is reinvested, in that year it will be treated as application of income. So while planning the activities of the trust, one has to be very careful. You have to see that loans taken and spent, amount taken from the corpus fund will not be treated as application of fund for current year's working. That is very important. And another important condition is that if a loan is taken or corpus fund is liquidated, it will have to be replaced within a period of 5 years. Then only you will get the benefit of at the time of repayment. Similarly, charitable trusts can give donations to other charitable trusts which are recognized by the department, which have 12-year registration. Only 85% of the amount given to a charitable trust will be treated as application for the current year, because the other charitable trust can also accumulate income to the extent of 15%. they need spend only 85%. So if one charitable trust gives a donation of 1 lakh to another charitable trust, for the first donor, only 85,000 rupees will be treated as accumulation of income. Another very important change is that the ATG benefit given to the Jawaharlal Nehru Memorial Fund, Indira Gandhi Memorial Fund, and Rajiv Gandhi Foundation has been withdrawn. They will not be eligible for donations. Another important change is that a charitable trust has to renew its registration before it expires. If a charitable trust operates without 12-year registration, then it will be deemed to have become non-charitable, and on that date, the assets will be valued, and the company and the charitable trust will have to pay tax on that income, accumulated income. So one has to be very careful with regard to renewal of registration. Similarly, in the case of charitable trust, the return of income has to be filed within the due date 139(1) or 139(4), and 1 month before filing the return, you have to file the Form 10B audit report. That also is very important. Suppose a charitable trust files a return under section 139(8)(a), updated return, then that will not be treated as a proper return. It will not be eligible for 12. Now, another important change is that when we receive a 148 notice, the return of income has to be filed in response to that notice within 1 month. Now the time limit has been extended to 3 months. That will be applicable for the assessment year 2024-25 onwards. The time limit, similarly, the time limit for completion of assessment has also been extended. Then with regard to appeals, a new post, Joint Commission Appeals, has been introduced. There are a lot of appeals pending in the first appellate stage. The number of commissioners is not adequate. So smaller cases will be dealt with by the Joint Commission of Appeals. Similarly, in the case of assessment, for the assessment year 2022-23, the time limit for completion of assessment is now 12 months, not 9 months as earlier. Similarly, during the course of assessment, there is a provision for special audit. That is, when the accounts are complicated and the assessing officer wants professional help, he can get the accounts audited by another chartered accountant. That's called a special audit. Now, the officer can take the help of a cost accountant also for verification of the valuation of stock and other cost-related aspects. Then there are certain other changes with regard to TDS and TCS. See, when there is a cash withdrawal from the bank, in the case of cooperative societies, because cooperative societies withdraw cash from the banks for disbursement to the members, and they are liable for this TDS, the limit has been increased to 3 crores from 1 crore. Then another very important change is that when we remit foreign exchange for the purposes of tourism, when we want to visit countries abroad and we remit foreign exchange, or for any other purpose, foreign exchange is being remitted, then the TCS at present is 5%, that is being increased to 20%. This will not apply to educational loans. Other than educational loans, for all other purposes, the TCS rate is now 20% instead of 5%. The TDS on online gaming is to be done without any threshold limit. That means even if you earn 10 rupees, you have to, that's the TDS rate. Another important change is that with regard to EPF withdrawal, when the person does not give his PAN number, the TDS will be at 30%. It is reduced to 20%. And with regard to the TDS, one more important aspect is that there are some cases where the income is offered, let us say in assessment year 2023-24, but the TDS is affected by the director in 2025-26 or 2024-25. There is income is shown in 1 year, the TDS is done in the subsequent year. Now there is no mechanism for claiming this TDS refund. Now the act has been amended. The government is yet to announce the method by which this can be done. But a provision is being made. When you have paid tax on the income in 1 year, TDS is deducted in the subsequent year, you can claim the TDS as refund. It's a very welcome measure. Similarly, in many sections, in the TDS sections, where the recipient of the money has not filed his return of income, then tax is to be deducted at a higher rate. That is, when the person who is receiving the amount has not filed the return, then TDS will be at a higher rate. Now, there are many cases where the recipient is not liable to file a return at all. Either his income is taxable below taxable limit, or it's a government entity not liable to income tax, and so on. Even in such cases, the director will have to deduct at the higher rate. To overcome this issue, where the recipient is not liable to file the return, then higher rate of tax TDS will not apply. With regard to section 269 SS and T, that is accepting or repaying deposits, loans, etc. In the case of primary agricultural credit societies and primary cooperative agricultural and rural development bank, the limit has been increased from 20,000 rupees to 2 lakhs. So in the case of these two cooperative societies, they can accept deposits from their members in cash up to 2 lakhs. Similarly, the deposit can also be repaid to them in cash up to 2 lakhs. So these are the important changes with regard to another important change is with regard to private limited companies, corporate entities. The MCA had amended the company accounting rules in 2014 in 2020 itself to provide that where a company is using an accounting software, the software shall contain a provision for audit trail. What is this audit trail? The audit trail is a logbook which will show when a particular entry was made, at what time and on what date, and by whom the entry was made. See, the objective is that there should not be any fudging of books. Once the books of accounts are prepared, there should not be any alterations. Many of the softwares contain a provision for changing the accounting entries without any trace. So now MCA has insisted that all softwares should contain a audit log. The audit log should be enabled. It should not be disenabled. And the audit log should show when an entry was originated, by whom it was originated, and what is the timestamp should be there. Similarly, when an entry is changed, amended, it should show what was the original entry and what is the amended entry, who changed the entry at what time. And the most important provision is that the audit trail should never be disenabled. It should always be there. So this new provision comes into effect from 1st April 2023. So for the financial year 2023-24, when we do the audit in 2024, the auditors are expected to verify whether there is an audit trail and what are the contents of this audit, audit log or this edit log, and what is the effect of these changes in the financial results. How it is to be reported is yet to be announced by the MCA, but as on date, from 1st April 2023, all companies using an accounting software should have an audit log and it should be enabled. That's a very important thing. Suppose a company does not have an audit log, the auditor will have to qualify the audit report, and that will have very adverse consequences. So with this, I will conclude my portion of the presentation. CA K.V. Padmanathan will deal with the indirect taxes. Thank you.
Indirect taxes. And indirect taxes and namukku
A warm good evening to all the participants. So we have just seen what are the major changes that are effective from 1st of April 2023 with respect to income tax. I'll be dealing mostly on the GST changes that are taking place from 1st of April, as well as few compliance measures to be taken for the year end. From accounting point of view as well as from your GST point of view. So the first compliance action which has to be done is with regard to the composition scheme. Under the GST law, both for supplier of goods as well as for supplier of services, a composition scheme is provided. For supplier of goods, for manufacturers and traders, the rate of tax which is applicable is 1% of the turnover in state. And for service providers, it is 6%, 3% under CGST and 3% under SGST. So total rate is 6%. The threshold limit for applying for composition scheme is 1.5 crores in the preceding financial year. So suppose a person want to apply for composition scheme for financial year 23-24, his aggregate turnover in 22-23 should not exceed 1.5 crores in case he is a dealer in services. He is a dealer in goods. That is, he is a trader in goods, or he is a manufacturer in goods. Suppose he is a supplier of service, his turnover should be less than 40 lakhs. Now, he has to apply for composition scheme by filing a form CMP02 in the GSTN portal. So this form has to be filed before 31st March 2023. So by the end of this week, CMP02 has to be filed online so that a person can opt for composition scheme. Another important point which I would like to discuss which is practically not seen, is that the composition dealers are supposed to clearly mark in their invoices as well as in their business premises that they are composition dealers and that they are not eligible to collect taxes. Because the main principle behind composition scheme is that you are paying taxes from your own hand. This 1% or 6%, it has to be paid from the hands of the composition dealer, not to be collected from the customer. So that has to be clearly indicated in the invoice as well as in the business premises. So this is not seen to be complied with by most of the composition dealers. So this can attract a general penalty under the GST law, that is 50,000 rupees, 25,000 under CGST and 25,000 under SGST. So this is something which has to be taken care of. Next, the composition who are already composition dealers for the financial year 22-23. So they were filing a quarterly return called CMP 04, in which they had to pay taxes. This composition 1% or 6%, they had to pay in CMP 04 in the electronic GSTN portal. Now, before 30th April 2023, they have to file an annual return in GSTR 4. So GSTR 4 is the annual return, compulsory annual return for composition dealers. So for financial year 22-23, if a dealer is a composition dealer, he has to file GSTR 4 within 30th April 2023. Another important compliance action to be taken is in case of exporters. It may be exporter of goods or exporter of services, or even persons who are supplying to special economic zone. So those who are exporting, so they have two options. Either they can export with payment of taxes, or they can export without payment of taxes. So if they are exporting without payment of taxes, they have to file a letter of undertaking with the government. So this letter of undertaking is to be filed online. So each year this letter of undertaking has to be renewed. So for financial year 22-23, the letter of undertaking expires on 31st March 2023. So for the next year, that is 23-24, if he is exporting, then he has to file a fresh letter of undertaking, or he has to renew the letter of undertaking. Or if he is a new registration, he has newly registered, then he has to file a application for letter of undertaking for the financial year 23-24. So this letter of undertaking is available under user services in the GSTN portal. User services letter of undertaking is available. So what are the consequences of non-filing of letter of undertaking? When you are applying for refund, the officer may deny the refund, saying that letter of undertaking is not furnished. Another important compliance action, which is applicable for all traders, which is a basic requirement, but which is not complied with, is that every year invoice series has to be changed. That is, suppose you are using the series A1, A2, A3, A4 for financial year, let us say 22-23. Now again, from 23-24, this A series has to be changed. It has to be changed to B series or C series, some other series. So ideally, it is better to have 2022-23/1, 2, 3 like that. And when the year changes, this can be changed to 23-24/1/2/3 like that. So the series has to be clearly changed. The reason behind is that tax invoices for a particular year, it has to be clearly distinguished from the tax invoices for the subsequent years. So in order to enable this, we have to clearly show for which year the tax invoice is being raised. This will apply to not only tax invoices but also bill of supply. That is, in case the person is supplying exempt goods, it has to be raised for bill of supply, then credit note, debit note. Then if he is accepting advances, like in the case of a builder, if he is accepting advances, then for receipt voucher also the serial number has to be changed. Now, Another important reporting requirement which has changed is HSN code. So from 1/4/2021 itself, there is a change, but last year most of the people have not complied with these changes. So at least from next year, from April, this compliance has to be done. That is, in case of turnover more than 5 crore, the turnover is more than 5 crore, then 6-digit HSN code has to be displayed in the invoice, as well as it has to be uploaded in the GSTR1 return. Now, if the turnover is less than 5 crore, then 4-digit compulsory HSN code is to be mandatorily shown, both in the invoice as well as in GSTR1. So the earlier up to 1.5 crore, up to 2021, up to 1.5 crore, there was no requirement for showing HSN code in the invoice as well as in the return. But now it is compulsory for everyone to disclose HSN code. So if the turnover is less than 5 crore, at least 4-digit HSN has to be shown. If it is more than 5 crore, 6-digit HSN has to be shown. So this has to be reported in the invoice also, so that we are able to reconcile the HSN with the values we have disclosed in GSTR1. And in the annual return also, HSN reporting is now compulsory. Without reporting HSN code, annual return cannot be filed. So this is one important change which has taken place. Now, another compliance measure to be taken for the industry is regarding the e-invoicing. So e-invoicing is a facility wherein an electronic invoice, that is a IRN code, has to be generated. So this code can be generated through softwares. So when the invoice is raised in the software, automatically the data will get uploaded in the GSTN portal. So this is basically the e-invoicing system. Various softwares like Tally, etc. These are providing e-invoicing solutions to their customers. So earlier the limit was 50 crore, then it was reduced. So first it was 200 crore, then it was made 100 crore, then 50 crore. Then recently it was made to 10 crores. Currently the threshold limit is 10 crore. So if the turnover of any registered person in financial year 22-23, that is from any year from 17-18 to 22-23 has exceeded 10 crore, then such person has to start e-invoicing from 1st of April 2023. So I'll give you an example. Let us say in 18-19, the turnover was 11 crore. Then after 18-19, in 19-20, the COVID started. So the turnover was less than 10 crore. 2021 and 21-22 also, due to COVID, his turnover is less than 10 crore. And let us say in 22-23 also, the turnover is less than 10 crore. Even then, since his turnover was more than 10 crore in 18-19, he will be liable for taking e-invoicing from 1st of April 2023. Then GST portal, they have issued some advisory regarding few updated websites for generating these e-invoices. So those websites I have displayed in the slide. So you can go through this website. So once these are available, e-invoice can be generated in these websites also. Then another compliance action to be taken is in case of QRMP scheme. So this QRMP scheme was introduced in 2021. So according to this scheme, the taxpayers can file return quarterly, but they have to make the GST payment monthly, on a monthly basis. So GSTR 1 and 3B can be filed quarterly, but every month the person has to self-assess their tax, and that tax has to be paid to the government. So this scheme has to be opted on a quarterly basis. So those who are already in QRMP scheme, they can opt out before the 30th April 2023 for the first quarter of April, that is April to June 2023. Now, if they want to opt in for QRMP scheme, that also have to be opted in before 30/4/2023. So basically, there is no advantage of this scheme because every month self-assessment has to be necessarily done. So instead of doing self-assessment and filing quarterly return, the taxpayers can straight away file monthly returns also. So it is always suggested to go for monthly scheme rather than going for QRMT scheme. Then another important return to be filed, which most people are not filing, is ITC 04. So many people are even not aware of this form. So ITC 04 is a form to be filed by registered person who is sending goods on job work basis. So I am a manufacturer. So I am sending my goods to a job worker for some process. And after the process, the job worker is returning the goods back to me. So I had to file a form called ITC 04. So ITC 04 was earlier quarterly return. Then later it has been now changed to make it annual return and half yearly return. So those who are having turnover up to 5 crore, they can file it annually. That is up to 5 crore, they have to file only once in a year. So for financial year 22-23, they have to file it on 25/4/2023. Last date is 25/4/2023. And those who are having turnover of above 5 crore, they have to file 2 returns. Half yearly they have to file. So second half of the year, that is from 1st October to 31st March, it has to be filed within 25/4/2023. So there is no late fee specified for ITC 04. However, if it is not filed, a general penalty can be levied. General penalty is 50,000 rupees, 25,000 under CGST and 25,000 under SGST. So this is another important measure to be taken. Those who are doing job work, they have to file this ITC 04. Then there are few changes which has taken place in registration. So this changes has been brought in by finance bill. So what is this change is that there are 3 sections which provide for registration. The first section is section 22, which says that a person whose threshold turnover is less than, more than 20 lakhs, he has to get himself registered. And section 23 provides certain person who are not liable for registration. So an agriculturist who is supplying his cultivation out of land, he need not take the registration under GST. Similarly, a person who is exclusively dealing in exempt goods, he also need not take registration. For example, a person who is, let us say, milk is exempted. A person who is exclusively engaged in selling milk, he need not take registration. Now the third section, section 24, provides for some situation where compulsory registration is required. So a person who is liable to pay reverse charge is required to take compulsory registration. Similarly, a person who is making interstate sale, he is also required to take compulsory registration. So earlier, if I was dealing exclusively in exempt goods, but I have some reverse charge payments like advocate fees or goods transport agency, then for the purpose of that reverse charge, I have to take registration. Now, after this amendment, that is not required. Section 23 will have an overriding effect over 22 and 24. So after this amendment is notified, if I am dealing exclusively in exempt goods, then I need not take registration even if I am liable to pay reverse charge or any other situation which is covered under section 24. That is like electronic commerce operator, interstate supply, etc. Provided I am selling only exempt goods or providing only exempt service. So this amendment is not yet notified. So once it is notified, this provision has to be seen at the time of taking registration. This is already over. This deadline is already over, but for information purpose, I am sharing once again. So recently, with effect from 13/7/2022, notification has been brought in, which says that goods transport agency, if they want, they can pay tax under forward charge. They have the option of paying tax under 5% without input tax credit or 12% with input tax credit, if they are opting to pay tax under forward charge. Under reverse charge, the recipient of service can also pay tax, but he can pay tax only under 5%. So this is the current system. So how will the recipient know whether the GTA is paying under forward charge or not? For that, there is a form which has to be filed by the GTA. So every financial year, before the commencement of the financial year, GTA has to file a form online if he is opting to pay tax under forward charge. Only if he is opting to pay tax under forward charge. So this form is in Annexure 5. So Annexure 5 was to be filed before 15th March 2023. That deadline is already over, but for information purpose, I am sharing. If a GTA has not exercised the option to pay tax under forward charge, then the recipient will have to pay tax under reverse charge. So soon the option will be available in the GSTN portal, whereby we can check whether the supplier, that is GTA supplier, he is paying under forward charge or not. If he is not paying under forward charge, then we as recipient, we have to pay under reverse charge. So supplier, if you are providing GTA service, you have to file Annexure 5 within 15th March every year to opt to pay under forward charge. If you are not, by default, you will be under reverse charge, but you are opting to pay under forward charge, you have to file Annexure 5. Then another important amendment which has taken place in the case of registration is in the GSTN portal is geocoding. So this geocoding was available in the MCA portal at the time of registering company. This geocoding option was provided, compulsorily provided. Now that option has been introduced in GST also. So now instead of address, a geocode will be generated. That is, for each location, a geocode will be generated in the GSTN portal, and that code will be used as a reference. So if there are various technical problems now, because various locations are not available in the geocoding. As a result, if we enter one location, the geocoding will take to another location. So there are various glitches in the GSTN portal, which is now being resolved. And now the updated geocoding, various other locations are also available. So there has been some changes in the GSTN portal, and they have issued an advisory saying that they have fixed the problems in the geocoding portal. So these are the amendments or changes which has taken place in the GST area. Now we are going to see from the finalization point of view, what are the reconciliations to be prepared? What are the various checkpoints to be taken to ensure that taxes has been correctly paid and all the input tax credit has been correctly availed? So what are the major steps to be taken? The first reconciliation which is to be done is your books of accounts versus your GSTR 1 versus your GSTR 3B. So all the three should be matching. Sales as per your books of account, as per your GSTR 1, and as per your GSTR 3B should be tallying. So if there is any difference between sales as per books of accounts and GSTR 3B, then that can invite notices. So if there is any amendment to be made, that can be made in GSTR 1. If there is any sales to be declared further, that can be declared in the return for the month of March itself. You need not wait till April or May after the end of the financial year. If it is identified now, then that can be corrected while filing the return for the month of March, which will be filed in April 20th. So this books versus GSTR 1 versus GSTR 3B will be an important comparison to correct the turnover as per your books of accounts and as per your GST records. Then this books versus 3B, how it is to be done? It has to be done both in tax rate wise. That is, suppose a person is having 2 or 3 tax rate, 12%, 18%, 5%. For each tax rate, this comparison has to be done to ensure that whatever tax has been collected, it has been properly paid to the government. Only if tax rate reconciliation is done, only then we will know that the tax which has been collected is correctly paid to the government. That is one important step. Second important step is with regard to B2B and B2C. Now, why this is important is because if we show the correct B2B supplies, only then our recipient can take the credit. So we have to reconcile the B2B supplies as per the books with the B2B supplies shown in GSTR 1. If there is any difference, then that amendment has to be done in the month of March itself, can be done in the month of March itself, so that the recipient can take credit in the same month. Otherwise, the credit will get delayed. So this is with regard to outward supplies. With regard to inward supplies, books of accounts has to be matched with GSTR 2B and also with input as credit taken in GSTR 3B. So books versus 2B versus 3B. So in various cases, what happens is that there are various expenses or purchases which are reflected in GSTR 2B, but due to some reasons, it may not be accounted in the books of accounts. So by doing this reconciliation, those entries which are missed out in the accounts, those entries can be passed now, and the books can be corrected as per the actual purchases. Now, it can also happen that various entries in GSTR 2B may not be relating to your purchases. That is, the supplier by mistake would have shown under shown as your purchases, whereas you would not have received such invoices and you would not have accounted in your books of accounts. So this has to be communicated with the supplier so that they can rectify their GSTR 2B, so that the correct purchases can get the credit, and it will not be reflected in your GSTR 2B also. So this measure has to be done. Another measure is that GSTR 3B credit, whatever credit we are taking in GSTR 3B, it should be supported by entry in GSTR 2B. So if there is any credit which is taken on the basis of invoice, but which is not appearing in GSTR 2B, then officer can issue notice and we will have to reverse that credit. So we have to ensure that all the credit which is taken in GSTR 3B is reflected in GSTR 2B. Now, another reconciliation which is to be done is your cash ledger and credit ledger as per your GSTN portal along with your books of accounts. Because if you are paying GST monthly, then you have to pass the payment entries in your books of accounts. And for the month of March, which will be paid in April, you have to pass a provision entry. So if these entries are missed out, it can be rectified by comparing the GSTN cash ledger and credit ledger with that in your books of accounts. And last one, which we are practically facing the problem now, is with regard to e-way bill, because now the center has also started issuing notices. Central GST department has also started issuing notices. The main reason for notice is that e-way bill has been generated, but it has not been shown in GSTR 1. So you have to reconcile the e-way bill with GSTR 1 and ensure that all the sales which you have done as per the e-way bill portal is duly recorded in the books and duly shown in GSTR 1. So there may be cases where e-way bill is generated, but it may not be sale. For example, goods are sent to job work. Then goods are sent for repairs. All these cases, e-way bill is generated, but it may not necessarily reflect in your sales. So this reconciliation has to be kept in handy so that whenever any notices is received, you can answer to those notices. Then with regard to output tax, what are the various check measures to be taken during the closing of this financial year? So first one is to verify the GST which has been paid on the entire turnover. So like I mentioned earlier, GSTR 1 versus GSTR 3B versus books of account has to be done to ensure that GST is paid on the total turnover. Then next important measure to be taken is that the goods and services are properly classified and correct tax rate is applied. For example, let us say a dealer is dealing in scrap. Scrap of metal is taxable at 18%. Scrap of wood is taxable at 5%. So we have to ensure that what is the actual product he is dealing, whether it is metal scrap or it is wood scrap. And if it is metal scrap, whether it is taxed at 18% and not at 5%. So excess, if he has paid excess tax, then there is a chance to claim refund. If he has short paid taxes, we have to pay the differential tax along with interest. So this is one important measure we have to take. The next important measure we have to take is ensure that GST is paid on all direct and indirect income. So if you see the tally, there may be various heads in direct income and indirect income, like freight, installation charges, erection charges, etc. So these may be collected from the customers, but what happens is that GST may not be discharged on this. So as we know that freight charges, when it is shown in the bill itself, it is a composite supply. Similarly, installation charges, when it is shown in the invoice itself, it is a composite supply. For example, we are dealing in, let us say, air conditioner. Air conditioner is taxable at 18%. If you are installing the air conditioner, then installation charges also we have to pay 18%. Now, I am a dealer in cement. Cement is taxable at 28%. If I am collecting transportation charges for transporting the cement to the customer's premises, this transportation charges will be also taxable at 28%. So you have to verify the direct income and indirect income ledger and see that correct taxes has been paid on direct income and indirect income. Another important checkpoint is that, is there any sale of motor vehicle during the year? Most of the dealers or most of the service providers, they'll be owning vehicle for personal use or for business use. This motor vehicle will be shown in the books of accounts of the dealer or the service provider. Now, we know that input tax credit is not available for motor vehicle. So where input tax credit is not taken, there is a notification called notification number 8/2018. So as per this 8/2018, where any motor vehicle is sold and that motor vehicle is shown in the books of accounts and also in the income tax returns, then GST has to be paid only on the margin. So what is the margin? Margin is the difference between sale price and the written down value as per Income Tax Act. So you have to go to your block of assets and see what is the written down value. So sale value minus written down value will be the margin on which 18% GST is applicable in case of sale of used motor vehicle. So you have to see the balance sheet and check whether any motor vehicle has been sold during the year. If it has been sold, then you have to arrive at the margin. If there is no margin, if the sale price is less than that WDV, that is written down value, then no GST is applicable. If there is a margin, 18% GST will be applicable on the margin. Now, what about other fixed assets? Other fixed assets, two options are there. Two things has to be checked. First one is sale value applicable GST. That is the first tax liability. Second tax liability is the input tax credit already taken. Now, from that input tax credit already taken, you have to reduce 5% for each quarter it has been put to use. So, for example, machinery has been put to use for 1 year. So 1 year, 4 quarters, each quarter 5%. So 20% has to be reduced from the input tax credit already taken. Remaining has to be reversed. So these two has to be compared, whether output tax is more or input reversal is more, and whichever is higher will have to be paid as output tax. So if input reversal is more, we have to reverse the input. If the output tax is more, we have to pay as output tax. Next important step to be taken is verify advances. This is applicable only in case of service providers. In case of goods, advance is exempted from GST. In case of service providers, GST will be applicable as and when advance is received. So in case of, let us say, a person who is engaged in building, construction, he will be liable to pay GST as and when he receives advance. So you have to verify the liability side of the balance sheet and see if any advances has been received. And if advance has been received for rendering any services, GST will be applicable at the applicable rate. Another important factor which has to be seen is in case of persons who are sending goods for job work. This is usually not complied, but this is very important compliance to be checked. If goods are sent for job work basis, the input has to be received within 1 year. If we are sending capital goods for job work, then that capital goods has to be received within 3 years. If the goods are not received within 1 year or 3 years, it has to be deemed to be sale. And when it will be deemed to be sale? From the date on which the goods were sent for job work. So at the end of the year 1, that is end of 1 year or end of 3 years, if the goods are not received back, he'll have to raise a predated invoice. He'll have to raise a predated invoice and he has to pay GST along with interest. So we have to verify that all the goods which are sent for job work has been received within 1 year. Next important consideration is your Form 26AS and your annual information summary. So in the income tax portal, from this year onwards, from the last year onwards, we are able to take an annual information summary, annual information statement. And we are also able to, earlier also it was available, Form 26AS, it shows TDS credits. So if any income has been received, which is omitted to be accounted in the books of accounts, but on which TDS has been deducted, then we can find such income from Form 26AS. Similarly, more detailed information will be available in the annual information summary. This has to be verified and ensure that all incomes appearing therein, which are liable to GST, has been properly paid. Next important compliance point is with regard to issuance of credit note and debit note. So we know that if we want to reduce the value of supply, we have to issue a credit note. And if we want to increase the value of supply, we have to issue a debit note. So the time limit for issuing credit note is, for the financial year 22-23 is up to November 2023. We have time up to November 2023. But if we have already ascertained any credit note or debit note to be issued, that can be issued within the end of the financial year, so that your books of accounts are tallying with the GST records. Then we have to, another common mistake which is being observed is that interstate supplies are being shown under the CGST SGST head instead of IGST head, and intrastate supplies are only shown under IGST head. So these mistakes are generally taking place in many of the clients' ledgers, and this has to be corrected, and this has to be ensured that it is as per the GST records also. So IGST has been, interstate supply has to be properly accounted under IGST head, and intrastate supply has to be properly accounted under CGST and SGST head. So these are all the compliance points with regard to output tax collection. Now with regard to input tax collection credit, the first step is to identify that all input tax credit which are available in GSTR 2B and which relates to our business has been properly accounted in the books of accounts. So if any invoices are omitted to be received, but it is duly reflected in GSTR 2B, then that has to be accounted now and the credit has to be taken now. That is one major consideration. So this will prevent any leakage of input tax credit. Now, second one, again, like I mentioned in outward supplies, what happens is that the supplier will give the bill in IGST. The accountant may wrongly enter it as CGST and SGST. Or it may also happen that supplier may wrongly give the bill as CGST, SGST instead of IGST. So in case the supplier has made a mistake, now that mistake has to be corrected. Either the supplier has to issue a credit note and issue a fresh invoice stating the correct tax, or if it is in the same month, he can amend that invoice also. So he has to give an amended invoice with the correct tax. So that has to be done. Now, if the mistake is with the accountant, then our accounts has to be corrected now. Instead of CGST, SGST, it has to be properly accounted in the IGST head. And if it is vice versa, then that correction has to be made. Now, this correction, if it is correctly reflected in GST, then there is no problem. If there is a mistake in GST portal also, that is, if the supplier has wrongly filed his GSTR1, then we should ask him to amend the GSTR1 also, so that it is correctly coming under the, it is appearing in the 2B under the correct head. That is another important consideration. Then there are various cases where debit notes and credit notes are issued by the supplier, but he will not be issuing hard copy of the debit note or credit note. Rather, it will be only appearing in the party statement. So this party statement will be received only at the end of the year. So now when the party statement is received, we should ensure that if any debit note has been issued by the supplier, that input as credit has to be taken. And if any credit note has been issued, then input as credit has to be reversed. Again, two types of credit notes are there. Commercial credit notes are there and GST credit notes are there. Reversal is required only in case of GST credit notes. Commercial credit note is only for passing entries in the books of accounts. They will not have any implication in the GST. Now, another important measure to ensure that input as credit is not missed is to ensure transaction between related parties, that is sister concerns. Or suppose a party is having registration, more than one registration in the same state or more than one registration in different states. So there may be transactions between these entities. So suppose a company is having head office in Tamil Nadu, Coimbatore, and a branch office in Palakkad. So the goods may be sent from Coimbatore to Palakkad and vice versa also. So these credits, whether they are properly accounted and whether they are properly taken in GST returns, this has to be verified. Now, apart from taking input as credit, there are various situations which require reversal of input as credit also. So these are the main situations which require reversal of input as credit, which we have to check. First one is payment within 180 days. We have to ensure that all payments to suppliers has to be made within 6 months, that is within 180 days. If payment is not made within 180 days, input as credit has to be reversed on such invoices. So this is very important. So we have to ensure that all payments are made within the proper time. Next one is in case of any goods destroyed or goods which are written off. So mostly in case of perishable goods, what happens is that there may be some wastage or there may be some goods which are damaged. So in case of these damaged goods or these goods which are expired, we have to make sure that input as credit is reversed. So this will most probably there in pharmaceutical industry, wherein medicines are usually expired after a particular time limit. So if there is any stock which is written off as expired, then that has to be input as credit corresponding has to be reversed. Similarly, if there is any fire which has broken out in the factory. So one of my clients recently, furniture dealer, there was a fire in his godown and his stock is being destroyed. A lot of stock is being destroyed. Now he has to reverse all the input as credit pertaining to that stock. So make sure that in case such misfortune has taken place to any of your clients, make sure that the input as credit has been reversed. Now another ledger which you have to verify is advertising, marketing, business promotion expenses. It may be accounted in any of these heads. So if you go to this, you can see that free compliments are given, such as diaries, bags, pens, water bottles, gift vouchers. All these are given as compliments to staff or maybe to customers or suppliers. So all these free samples, input as credit is not available. In case of pharmaceutical companies also, they have a practice of giving free samples to doctors. So in such cases also, input as credit is not available wherever any goods are given as free samples. Now, another important complaints is with regard to Rule 42 and 43. So Rule 42 and 43 applies when the dealer is dealing in taxable goods as well as exempt goods. A classic example in Palakkad is rice mills. So rice mills from last year onwards, there was an amendment that if they are selling in a particular quantity, which is pre-packed and pre-labeled, then it will be taxable. If they are selling as wholesale without any pack, then it will be exempt. So rice mill dealers, they have both pre-packed quantity, that is 25 kg and less, as well as more than 25 kg also. So if it is pre-packed and pre-labeled, then it will be taxable. And if it is in sold as loose, sold as bulk, then it will be exempt. So input as credit has to be apportioned between this taxable and exempt. Common input as credit has to be apportioned between taxable and exempt based on the turnover. This is as per Rule 42 and Rule 43. Rule 42 is with regard to input and input services. 43 is with regard to capital goods such as machinery, vehicle, etc. Now, again, ineligible credits. You have to verify that input as credit is not taken on any ineligible credits. So most common ineligible credits are passenger vehicle, cars which are purchased in the name of firm or in the name of proprietor or the company. Then hiring or renting of car. If you have availed services of hiring or renting of car, it is also blocked credit. Then food and beverages, then catering services. All these are blocked credit. If any input as credit has been taken, then such credit has to be reversed. Then again, fixed assets sold, as I earlier mentioned, we have to check two things, whether we are liable to pay output tax or input reversal. Whichever is higher will apply. So input reversal has to be done on the basis of 5% for each quarter. So suppose it has been used for 1 year, then 4 quarters are there, into 5%, 20% of the input as credit has to be reversed. So if it is used for 1.5 years, then it will be 6 quarters. So 6 into 5%, so 30% will have to be reduced. Now, again, we have to verify the 2B to see whether any credit note has to be issued by the supplier. Many times, supplier would have issued credit note, but it would be reflected in the party statement. There is no manual, hard copy of the credit note available. So this entry will not be passed in the books of accounts. So we have to verify the GSTR 2B. There is a separate column called CDN, that is credit note and debit note. And we have to verify that there is entries appearing in CDN has been properly accounted in the books of account and reversal has been made. Now, there is also a possibility that the supplier has made any amendments. He has wrongly shown your bill of 10,000 as 1 lakh. Then later on, he understood the mistake and corrected it to 10,000 or whatever is the correct value. So this amendment will reflect in B2BA. So this B2BA has to be checked and ensured that reversal, if any, has been properly done. So credit note and amendments in GSTR 2B is another document which you have to verify to see that all the reversal has been properly made. Finally, any difference between GSTR 2B and 3B? If there is any entries which are not appearing in GSTR 2B, the supplier has not shown it, then we will not be liable for availing the input as credit. So we have to ensure that all the entries in GSTR 3B is supported by corresponding entries in GSTR 2B. Then, with regard to reverse charge mechanism, this is one of the most important areas because most notices are coming in this area with regard to reverse charge. So what is reverse charge? Usually the supplier is liable to collect GST and pay to the government. Where any services has been notified under reverse charge, the recipient himself has to pay the tax and he can avail the credit. So this reverse charge items most commonly will be appearing in the expense side of the P&L account. So what are they? First one is GTA services. You can check your freight inwards and freight outward expenses. If these freight charges are paid by you, then you are liable to pay GST on that. So the rate of GST is 5%. Earlier there was a limit of 1,500 and 750. Now there is no limit. So now there is no limit. Any amount of GTA which is appearing in GSTR, which is appearing in your accounts, 5% has to be paid on that. Next one is legal fee. That is amount paid to advocate fees. So any amount paid to advocate for representation, any services, GST will be applicable at 18%. Then security services, again, if you are availed security services, reverse charge will apply at the rate of 18%. Then renting of motor vehicles. So renting of motor vehicle, please see the circular 177/2022, which says in which situation the recipient has to pay GST. So whether the person who is renting motor vehicle has to pay GST, at what rate he has to pay, and if he is not paying, whether the recipient is liable to pay and at what rate he has to pay. It is clarified in this circular. So briefly, renting of motor vehicle, if the supplier is a non-company and recipient is a company or any other registered person, he will be liable to pay at the rate of 5% without input tax credit. Then sponsorship. If there is any sponsorship, if you check the advertisement, marketing or sales promotion expenses, if there is any amount paid as sponsorship, it may be to any association, it may be to any trust, it may be to any company. If there is any sponsorship paid, then on that amount reverse charge will apply. Then import of services. If any services has been imported, import of services, reverse charge will apply. Then services provided by government. This is very important. Services provided by government. So any factory license, pollution license, then any other services which is provided by the government. On all these services, if the value is more than 5,000 rupees, then reverse charge is applicable. Then renting of residential dwelling. This is a recent amendment. If any registered person, he is taking a residential premises for rent, then such person who is taking the residential premises, registered person, he will be liable to pay reverse charge. Only one exemption is provided. If the person who is taking the residential premises for rent, he is a individual, he is a proprietor, and he is taking it for his own use, then there is no GST applicable. So I'll give one example. Suppose let us say I'm a proprietor, and I am taking a house for rent, for staying, my own staying. Then reverse charge will not apply. Now let us say that I am a director in a company, and that company is taking a house for rent, for providing accommodation, or providing guest house. Then the company will have to pay GST on reverse charge basis, 18%. So these are all the cases which are normally applicable in case of reverse charge. Now, another important reverse charge compliance is in case of real estate developers. In case of real estate developers, they are liable to pay tax at two rates, 5% and 1%. If they are providing affordable housing project, if they are constructing affordable housing project, then the tax rate applicable is 1%. And if they are constructing normal apartments, then the tax rate applicable is 5%. So in this 5% and 1%, input tax credit is not available. And there is also one condition that 80% of their inward supplies, 80% of their purchases and inward supplies, it should be from registered person. So if it falls below this 80%, then that shortfall has to be paid as reverse charge. Let us say that I am purchasing only 70% from registered persons. The remaining 10%, it is from unregistered persons. Then on this 10%, I'll have to pay reverse charge. So at what rate I am liable to pay? If it is cement purchases, I am liable to pay 28%. All other purchases, I am liable to pay 18%. So this shortfall has to be checked whether it is cement dealers or other dealers. If it is from cement dealers, then 28% will apply. If it is other dealers, then normal 18% will apply, only to the extent of the shortfall. Now, if any reverse charge is not paid till now, that can be paid in the month of March, and input tax credit can also be availed within the time limit. So that is another important point to be checked. So these are all the important compliance aspect which has to be seen from the GST point of view and also from your books of accounts point of view. Apart from this, I think what is only left out is with regard to TDS. So briefly, income tax TDS, one thing which has to be checked is if your turnover is more than 10 crore during 22-23. If your turnover is more than 10 crore during 22-23, then in 23-24, if any transaction, whether it is purchase transaction or sale transaction within a single party, purchasing from a single party or selling to a party, if it exceeds 50 lakhs, then in case of purchases, TDS will apply. That is, when you make the payment towards the purchases, you have to deduct TDS under 194Q. In case of sales, if you are making sales of more than 50 lakhs to a party, you have to collect TCS. You have to collect TCS at the rate of 0.1%. Purchases TDS at the rate of 0.1%, 0.1%, 194Q, and TCS at the rate of 0.1% if the sales exceeds 50 lakh. This is applicable only if the turnover during 22-23 is more than 10 crore. This is another important point. So if any of your clients' turnover is more than 10 crore during the previous year, make sure that they comply with the TDS provision in the 23-24. All other TDS has been covered. So with this, thank you. Now we'll open for any questions. We'll open for questions. If there is any questions, we can discuss. If there is no questions, we can wind up the session. If there is any questions, you may either put it in the chat box or you can ask. So thank you one and all for attending today's session. So in the coming year also, we'll be having sessions like this, possibly as and when any changes are taking place, to keep everyone informed about the recent changes. Thank you once again, and wish you all a good night. Thank you.
Thank you, sir.